Thanks to the folks over at the blog website Wall Street on Parade, we're getting even more information about the truth of the 2019 Repo Madness crisis, and it's insane. So a few weeks ago, I talked about how the number was 11 trillion. Well, more and more disclosures from banks, investment banks, and other investigative reporting is being done by Wall Street on Parade. They found disclosures recently from a Japanese investment bank, Nomura Securities, that they had over 3 trillion. It's actually closer to 4 trillion in exposure borrowing from the repo market here in the United States in 2019. And a lot of these repo trades went bust. I've talked about Repo Madness a lot. I did probably more videos than anyone about the 2019 repo crisis. I dubbed it Repo Madness. Bloomberg News even copied it, and so did Real Vision and some of the other main financial YouTube channels and news websites. They started calling it Repo Madness back in 2019. But I put a lot of videos out there back then going through the details, talking about how investment banks and hedge funds had blown up and the Fed was doing all these secret bailouts. Well, it looks like the real number that we have now, after more and more news stories are coming out, that Wall Street on Parade is going through these research documents. The mainstream financial media is not doing it. Investigative reporters are not doing it. It's a blog website called Wall Street on Parade. They are the ones that are doing the hard work. They're not making the overpaid salaries that mainstream financial media is making. And it looks like the real number for the 2019 Repo Madness bailouts are $19 trillion, at least $19 trillion. The other major point I wanted to make on this video is that now we have some proof that the Federal Reserve Bank bailed out another large foreign bank. This is a Japanese investment bank, Nomura Securities, for potentially trillions of dollars. So in the 2008-2009 financial crisis, the Fed, without taxpayer approval, bailed out the European Union. They also bailed out European banks for trillions of dollars in derivatives losses with these currency swap loans that were then forgiven. I found proof in a 2020 Fed financial stability disclosure form, and I provided screenshots in a Patreon article for patrons behind the paywall back in 2020 that the Fed still had currency swap loans, was still giving out trillions in currency swap loans to the European Union and European banks in 2011, 2012, 2013, when the Federal Reserve Bank was adamant that the currency swap loans for trillions were only given out to the European Central Bank in 2009, 2010, and within about a year, these loans were paid off and forgiven. I found out proof that they were lying. So that's behind the paywall over on Patreon. But the bottom line here is that the large banks and government central banks, especially the Federal Reserve, which has the dollar as a world reserve currency, they can bail out whoever they want, whether that's European banks or Japanese banks or entire governments if they want. And now we have even more information out that a large Japanese investment bank, Nomura Securities, was probably playing in the derivatives market with way too much leverage, and they had a derivatives bet blow up. They borrowed from repo, leveraged up a derivatives trade, and the trade blew up, probably when the Fed was reducing their balance sheet and hiking interest rates back in 2019. The other thing I wanted to mention, because I had someone bring this up, for those of you who are new to my YouTube channel, I talk about toxic sausage. That's actually an analogy I use for mortgage-backed securities, for collateralized loan obligations, for collateralized debt obligations. These are very sophisticated credit derivatives and financial products that are often made by people with PhDs in mathematics or rocket science even. And these things are like chopped up, similar to how sausage is made. They're chopped up into pieces. And a lot of times, a lot of financial professionals don't even know what's in these things half the time. Different levels of tranches, different levels of risk. And then they're sold to pension funds as different levels of risk, when in reality, these things are much higher risk than they would appear. So like collateralized loan obligations or CLOs, leveraged loans, collateralized debt obligations, mortgage-backed securities, commercial real estate mortgage-backed securities. That's why I call this stuff toxic sausage, because of all the potentially dangerous and bad loans that could blow up that's in there that is not correctly rated. So I think that analogy of toxic sausage for these types of derivatives is accurate. And unfortunately, with repo, a lot of hedge funds, a lot of family offices, a lot of portfolio managers at investment banks, a lot of bond traders at investment banks leveraged up their trades. They went to the repo market, they borrowed in repo, and then they went and made big bets. And that's why we had the big blow up in 2019, because interest rates moved and because the Fed reduced its balance sheet. So we may have something similar in the not too distant future if the Fed actually does decide to raise interest rates. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content research, financial education, and analysis than I provide in this short little free video, there are now over 190 articles and audio podcasts behind the paywall, all for only $5 a month. I think it is one of the best deals out there, and that's exclusive for patrons. And just in the last 27 or so weeks, there are now 39 new articles and audio podcasts, including 8 new articles and audio podcasts out in the last 5 weeks. Again, that's only $5 a month. So please check that out. There are a lot of interesting audio podcasts and articles on gold mining, silver mining, precious metal royalty and streaming companies, uranium, oil and gas, and other commodities and global macro related topics. So if I could wrap up this short little video very quickly, we now have even more proof that the Fed in the 2019 Repo Madness crisis bailed out foreign investment banks for trillions of dollars. The total size of the Repo Madness bailouts in 2019, I knew it was in the trillions, many trillions at the time back in 2019. You can go back in the archives of my Repo Madness videos from back then and listen to me predicting that hedge funds, investment banks all blew up, that the bailouts were many, many trillions. But now we have even more proof. I'll attach links to these Wall Street on Parade articles below the video in the information and description section. But now we have definitive proof that a large Japanese investment bank had almost $4 trillion borrowed from the US repo markets. They had trades blow up, and it looks like they got bailed out. And the average person doesn't know this, but the real size of the bailouts in 2008 and 2009 by the Federal Reserve Bank and the US government for the entire global financial system was many tens of trillions. Dr. Ron Paul got a one-time partial Fed audit. That number was 16 trillion. There was a Bloomberg News Freedom of Information Act request, also I believe in 2011. And that number, there was over 30,000 documents that were dumped. The Levy Institute went through that and said that the real amount of the bailouts, the total commitment, and the largest amount of the commitments for the bailouts in 2008 and 2009 from the Federal Reserve Bank was to the European Union and to the European Central Bank and bailing out European banks, large European banks, that the total commitment just to Europe was like 8 or 9 trillion, and the total size of the bailouts in 2008, 2009, according to the Levy Institute, after they went through a bunch of different documents, was over 29 trillion. So every 2 to 5 years now, because of the amount of leverage in the system, because of how over-leveraged so many of these traders are, how desperate they are to produce short-term results, they don't really think about risk as much as they think about reward. And then you have all these blow-ups because of how fragile the entire global financial system is. It's fragile because of debt. It's fragile because of leverage. And then all it takes is a couple interest rate hikes, or even the threat of interest rate hikes, and then you potentially have another 2019 Repo Madness crisis. It's probably going to be a little bit different than the last Repo Madness crisis because the Fed already anticipated another potential repo crisis and has already installed back in 2021 2 permanent repo facilities, a domestic repo facility for bailouts and a foreign central bank repo facility for bailouts. So I am very disturbed by what's coming out. I'm glad we're getting the truth though, but unfortunately the system is not going to change because Wall Street doesn't want transparency, the mainstream financial media doesn't want transparency, the Federal Reserve Bank does not want transparency, and most importantly, the scumbag politicians, bureaucrats, and regulators here in DC do not want transparency.